Hey everyone, Anthony Venuto here with In Touch Mortgage Solutions. It's Friday, Finance Fridays, and on this episode, we're going to be talking about the annual mortgage statement, renewals, fixed versus variable, and having that conversation about what you should be doing if your mortgage is coming up for renewal in the next little while. So stay tuned, you don't want to miss it. As we are in the last few weeks of December and ending off 2022, many Canadians with mortgages are going to be getting or receiving their annual mortgage statements. Many may have already received them. Now, this document is a very important instrument in order to determine a few different components, especially if you have a variable rate mortgage. For many clients who are on a static payment or a basic trigger rate mortgage, you will want to take a look at how much money has been contributed to principal versus interest from maybe your previous annual statement to this year, and you'll also want to pay attention to that amortization, as some lenders do not actually report amortization on their online portals. You may need to get that annual mortgage statement. So looking at some of these components can help you better understand how your mortgage is situated and if there's any changes that you need to make in the coming year. More importantly, when is that mortgage going to come up for renewal? Are you approaching that renewal in the early part of 2023? And if so, what should you be considering moving forward? Obviously, with fixed rate mortgages and variable rate mortgages being much higher than maybe when you originated that mortgage, and definitely up from earlier part of 2022, making that decision can be even more challenging depending on your family's finances and budget. For many Canadians with an adjustable rate mortgage, those ones that their payments have increased significantly and changed every single time the Bank of Canada made a policy rate decision and prime had gone up, you would have felt those payments increase immediately. And for those on those static payments, you may have to consider if you've breached your trigger rate and if you will have to increase those payments. Over the last little while, we have been talking to some clients that are approaching the renewal window in the earlier part of 2023. And in an effort to help keep more money in their pocket, we are definitely looking at options. Now, options because the fact that fixed rate mortgages and variable rate mortgages have now diverged, where variable rate mortgages are more expensive, especially with the most recent increase to the policy rate and prime. Prime has now jumped to 6.45% with most lenders, and even taking into consideration discounts at -40 or 50, you're still in the upper 5%, if not 6% mark. And fixed rate mortgages for potentials for switches and transfers are well below the 5% mark right now. Now we'll get into the rates and more at the end of the video, but I want to just present a scenario where we had a client reach out to us who wanted to securitize a fixed rate mortgage for 5 years. And after going over the conversation pieces with the client, talking about obviously the pros and cons of fixed and variable 1 to 3 year products, the family and the client themselves have decided to basically lock in with a 5-year fixed mortgage at 4.79%, based on the fact that they are going to be more comfortable knowing that for the next few years their payment will not be changing. Now, why is that important to understand was because the client had received their renewal notice from their lender, and the rates that were being provided were much higher than what we were able to offer the client. And the client basically looked at the options, was comfortable with losing their line of credit, and was more happy to understand that, hey, I still have 15% prepayment privileges, I still have the ability to port or transfer that mortgage, and we still have the flexibility to know that the penalty is going to be less than the conventional bank. And obviously, those are important things to consider. So what I want to do right now is just go over the quick scenario on how and what we presented to the client and why it led them to make this decision. On the screen, you'll notice the scenario that we built into them using our Canadian mortgage app, the one that you can find in the description box below. The client was basically looking at the two options. If they were to renew the mortgage with the rate that we're able to provide them on a variable, which was prime -1%, their rate would have been 5.45%, and their payments would have been around $3,055.53 per month. Obviously, looking at the principal and interest paid on each and every payment, providing that the interest rates do not change. This was the key caveat. Obviously, when selecting the variable rate mortgage, the client was concerned with where the variable rates were going to be headed. And the client was just given that information and used to basically make a decision. So even with a significant discount, the client was very apprehensive about selecting a variable rate mortgage at this particular time. But keeping in mind that this is a 25-year amortization, and the clients did also qualify to switch to a different lender, and they were able to get an insurable rate product, not a conventional product at 30 years. So if you look at the amortization summary presented, you will see how that principal and interest will be broken down over the next 5 years, providing that interest rates do not move. Now, if we put that in comparison to the fixed rate mortgage, which their payment would have been significantly lower at $2,848.54, basically just over $200 a month in savings, they'll notice that the principal is a little bit higher and the interest portion is a little bit lower. And obviously keeping in mind that this was the renewal amount of around $500,000, the rate being 4.79%, you will notice on the next slide here that the client's total interest and principal paid will be a lot more towards principal and a lot less towards interest because of the rate being much lower. So this is an important understanding when you look at rates. It doesn't matter necessarily, if you're taking fixed or variable, it's all based on the rate. The higher the rate, the more money will go towards interest than towards principal. And understanding obviously the differences between fixed and variable and what was right for the client. The important conversation during this time when selecting this product was understanding the family. Are they going to move? Are they going to sell? Are they going to be looking to make a move in the next little while? And the clients had basically done some extensive renovations to the home. They don't need to refinance the mortgage. They're in a comfortable position and they plan to stay here for 5 years or more. So that was some of the major deciding factors in why they selected a fixed rate mortgage. So each case is obviously individual. It is circumstantial to what you see moving forward. If you're a first-time home buyer and you're buying a condo where you're planning to move in a few years, obviously selecting a term and product that's going to meet those needs is going to be more important because of the fact that there are penalties with fixed rate mortgages, and depending on the type of lender and product, there could be additional clauses like the only way to refinance is to basically stay with that lender, bona fide sales clause, meaning you can't refinance. If you're with particular lenders, that means you have to sell the home. Obviously, a lot of different things to consider. That's why it's important to talk to a mortgage professional who understands the differences between products and can give you the advice so that it doesn't come as a shock in the future if something catastrophic changes and you need to exit that mortgage. You should be aware of everything ahead of you. Now, speaking of what is ahead, obviously looking at interest rates at the current moment for the week ending December 16th, obviously there are some significant changes to interest rates from where we were just a few weeks and a few months ago, as we've seen some of the interest rates come down with major changes to insured mortgages. So insured and insurable mortgages are pretty much the same right now. You're looking at a starting point of around 4.79%, all the way up to 5.89%. And variable rate mortgages, which are not as aggressive, are anywhere from 5.45% all the way up to 5.55% with lenders that offer you multiple solutions, like obviously even lines of credits, even products such as transfers and ports, and obviously advantageous prepayment privileges. So understanding the differences there. And obviously to refinance or restructure on a 30-year amortization, those payments and interest rates are going to be a little bit more expensive because of the fact that it's not insured. These mortgages are basically on the bank's balance sheets, and there is a premium for that. And we see rates starting at 5.24% all the way up to 5.89, 5.99%, and variables in and around the 5.90% all the way up to 6.5%. So looking at some of those rates, and obviously one new component to the interest rates is the insurable 1 to 3 year products. Some of our lenders have come out with these lower interest rates or insurable products for 1 to 3 years. Now they have been around, but basically now it is more of a popular product, and you can see those rates starting at 5.34% all the way up to 6.24% for insured and insurable rates. And obviously those, if you're looking at the 1 to 3 year mark, for non-insurable, those are 30-year amortizations. They're slightly bit higher at starting around 5.39% to 6.29%. And conventional rates have come down a little bit from their previous highs, and they're starting at around 5.19% all the way up to 5.89%, and going pretty much straight across the board, as these are conventional 30-year amortizations. And one important part is the B lenders for those clients that might have some significant issues with credit or income, or might find themselves in a situation that they have to leave their particular conventional bank and move into an equity lender due to some particular situation that requires it. Obviously, those rates are much higher, and they're starting at 6.39% plus a 1% fee, depending on the credit and obviously the circumstance. So those are some of the rates that you're seeing in the marketplace right now. Those can change at any given time. We have seen a lot of volatility in these rates as they are dependent on either the central bank and the Bank of Canada and policy rate, or the bond market and what is happening, and obviously the 5-year treasuries, as these are the major indicators for these fixed rate mortgages. And we'll keep you posted on what is happening with interest rates. And if you like this type of content, you want to know more about what is happening with interest rates, don't forget to hit that like, share, and subscribe button. Hit that notification bell so more Canadians like you can get this content, and we can help provide that information out to many Canadians. But we'll leave the video here. We hope that everyone found it helpful and informative, and we wish everyone a great Friday and an even better weekend ahead. Thank you again for watching, and thanks for clicking. Have a great one.